Hello, welcome back. Not a pretty picture to see, right? Netflix going down 36%. We have made a couple of videos about it. I kinda made a video to warn investors that we could be seeing some decline in Netflix. I didn't expect it to be that much, but I did know that the stock was overvalued, massively overvalued, and I have examined that before the earnings. You can see the video. I have actually made a couple of videos about it again, and I'm gonna link to that at the end of the video. It's gonna point you to the video that I made right before the earnings of the company, and I was examining how much Netflix is worth and how much I would be willing to pay for it, and you will see what the result was. But in this video, I wanted to talk about a company that people are looking at right now, and it makes a ton of sense. This is the Walt Disney Company. The tool will actually analyze and fetch all the data for us automatically. And this is a sympathy play. This is a company in the same industry, a streaming company, and it's actually having a decline again because of Netflix. I actually expected this one to be steeper, like 10% or so. Seems to be holding relatively well based on what is happening right now with the trend. And it's down 4.4%. And I did make a video about Disney, but of course we have massive news with Netflix right now. And so I wanted to actually create an update, and people who are new here can actually see what's going on with Disney and whether it's a potentially interesting buy and whether you can make good money out of it with less risk. And if you haven't been here before, remember to subscribe, because very, very soon I'm going to be giving access to this tool. I will let you know how to get access. And you may want to like it as well, because that really, really helps with the channel. So thank you for that. And yeah, leave a comment as well. Tell me what you think about Disney. But in this video, we're going to examine what the company is doing financially, because we want to be very, very objective. We don't want to be purchasing something because it's going down. And it's easy to see that the stock price has been going down in the 6 months. But if we take a look at the 5-year chart, or even better, the max chart, you will see that the company has been a massive high flyer. It almost reached $200 before it retraced, but back to 126, which it is right now. It's still a very lucrative company, the $130 billion company here. But let's take a look at the P/E ratio here. You'll see that it used to be higher, but still pretty elevated. At least it's positive, but it's very high, 78. Same thing with the price to free cash flow, positive but very, very high. 162 is nothing to sneeze at, it's very, very high. Outstanding shares, the company has been issuing some shares. Frankly, I expected them to issue more based on this kind of growth that they were having. They are funding themselves through that, of course. Now, this is interesting. Free cash flow to total liabilities ratio is sitting at 56 almost. This means that it would take about 56 years of last year's free cash flow to pay all the total liabilities that the company has. And this is an interesting metric here, because it tells us how much debt the company, or liabilities pretty much, the company has when you compare it to their current free cash flow of last year. That gives you a very, very interesting metric to know about in terms of the liabilities that the company has, so that you know how solvent they are. Now, the 5-year revenue growth is sitting at 22%. It has been increasing, yes, but the net income growth and the free cash flow growth has been suppressed. And as you can see here, mainly because of the pandemic. It's the pandemic years in which it has gone down, of course. Kind of expected. Total equity growth has been increasing, though I'm pretty sure funded by the outstanding shares here, of course, right? The company has been printing a lot of shares, so there's no other way really that the company made this kind of extra equity here, because they didn't make it from operations. Their net income has been going down, as you'll see in their free cash flow. So we know that this happened because of outstanding shares, or actually maybe, yeah, they actually got some debt or something of that sort. Now, you'll see here that the net income margin of the company is 3%, and the return on capital employed is also sitting at 3%. That's actually fairly bad here. It's not great. It's not a great number. It's fairly low. And the good thing about it is the price to earnings growth ratio. That's a little bit better here. But what I want to examine is the financial statements in detail here. See exactly what the company is doing. Now, the revenue has been growing here, but it was suppressed, of course, in 2020 and 2021. Not much growth going on. It actually went down a little bit. Now, if you take a look at the net income, though, it went down massively in 2020. That's the pandemic years, when the pandemic started. You'll see that it used to be at about 9 to 10, maybe 12 billion here, and now it's sitting at 2. So one thing that we're expecting from this company is to actually grow its net income in the next few years, potentially reaching its previous levels. So that would probably mean that they could increase their revenue as well. But it's something that we can factor in our calculations for the stock evaluation tool here and be a little bit more aggressive. We'll see that later. Let's take a look at the balance sheet here. What I want to examine is the total liabilities, 110 billion. Remember, the number was 55 in terms of its free cash flow. So we're looking at about $2 billion in free cash flow last year is what this number tells us already. Total equity is sitting at 93 billion. We know that the company has actually funded their equity through shares, so actually issuing shares. Cash flow here. The net income of 2020 has been negative here, as you'll see, yet the net cash provided by operating activities has been very, very positive. And the reason why this happens, of course, with media companies, depreciation and amortization. These companies make a lot of content, then they amortize it through years, and this actually adds money back, adds a number basically back to the free cash flow statement. Because it's a non-cash expense. Amortization is a non-cash expense, and it's added back to the net cash provided by operating activities here, and this is why you see a positive number. Same thing with 2021, of course, and again, this is why we're seeing a positive number here. And the next thing that I want to examine is the cash from investing activities. The company has been investing slightly, mostly in property, plant, and equipment, typical things, a little bit of capital expenditure, pretty much the same every year. And free cash flow here, that as we know already, it's about 2 billion. We kind of knew that already because of the ratios that we examined earlier. But it has been going down, as you'll see here. Now the question is the stock evaluation tool, what's going to tell us? The company has had suppressed revenues, of course, in 2020, 2021 getting a little bit better. Overall, they are making 3 to 4%. We're kind of going to go at about these levels. Let's go 3, 4, and 5. I'm going to be a little bit more aggressive with some projections because I'm expecting the company to flourish after the pandemic, to tell you the truth. I expect some growth in terms of revenue. That's a 5-year free cash flow model, by the way, discounted cash flow model. So I think that makes sense. Net income margins, again here, I'm going to go with the higher ones, not the lower ones, because again, they have been suppressed for a while. I'm going to go with like 16 and 21. I think this will make more sense. It may actually even be higher, is what I'm expecting for the next few years. So I'm going to go again, I'm going to go a little bit aggressive here, 15, 18, 21. I think this is an opportunity, and this is a case where it actually makes sense to go a little bit aggressive because of the suppressing revenues due to the pandemic. The free cash flow margin here, 97, 78, and then it has gone astray. Again, I'm going to be a little bit aggressive here. I'm going to go 90, 100, and 105, an annual return of 13%. And you're noticing that I'm using aggressive estimates, so bear that in mind before I hit calculate. Let's see what we're getting. And with these aggressive estimates, it's basically our high ones that are giving us a good price or a price to enter right now. The other ones are a little bit lower. The low one is substantially lower actually than the current price. So Disney right now is looking interesting, but for the most part, mostly for the high estimates here with a revenue growth of 5%, which bear in mind that the company hasn't really achieved in the past 5 years. So this is very, very offensive here. So this may never happen. And pretty good, pretty great net income margins here and free cash flow margins. I think the more likely one is the medium one, to tell you the truth, which is sitting at 105. So frankly, if the company was at around $100, maybe a little bit less, this is where I would look to get into this one. But it's a much, much better opportunity in my eyes than Netflix is right now. Again, based on the whole valuation. Tell me what you think about Netflix and Disney. Which one do you prefer? I'm going to make another video about another streaming company, which I feel is an interesting case to take a look at right now. Because, this is about this kind of companies these days, the streaming ones, because of Netflix, because of what happened with Netflix. So, yeah, stay tuned. There's going to be another one very, very soon. And please remember to leave a like and subscribe. And, in the meantime, you may want to take a look at a video that I made earlier, a few days ago, actually. And in that one, I'm talking about cycles and a cyclical company. That company is Royal Cruise. Take a look at this one. It may give you some ideas. And thank you for watching the video. See you soon. Bye-bye.